You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
It's tough. I mean, the gold stock climate is as bad as I've seen it, but I ain't selling. I ain't selling, and in fact, I'm moving around and maybe selling some of the things that haven't been hit quite as bad to buy some of the real bargains that I see. I mean, the bargains out here are just stunning, and of course, it doesn't feel good to buy in these kinds of conditions, but boy, history says that if you do buy in these kind of conditions, you can be very well rewarded for it.
Welcome back to Mining Stock Education. I'm your host, Bill Powers, speaking today with Larry Lepard from Equity Management Associates. Website is EMA2.com. Larry, welcome back onto the show, and I've received probably 4 emails in the last month or so requesting an update from you on your take on gold stocks. You manage a gold stock fund. Just jump right into it.
Yeah, sure. Well, look, it's been absolutely horrible, and everyone who's in this category probably, feels pretty beaten up, and they're kind of wondering if they're wrong for being in this category. Even I, who died in the bull on this stuff, at times it gets annoying to me too. I mean, this reminds me very much of the 2015 period before the bull market started in 2016, and also a little bit the 2017 period where we had kind of an interregnum before the next one got going. And so, to reprise everything, as we all know, we were kind of stuck at 1365. We took off in 18, 19, 20, went up to 2000. The gold stocks went crazy. My fund went up 97% and 122% back-to-back years. And then we peaked in kind of mid to late 2000, and then, 2021 and 2022, and now a little over halfway through 2023, with this rapid Fed hiking cycle has just put the kibosh on all of these stocks. And the stocks more than the metal, as you and I discussed pre when we got going, it's impressive to me and a bullish factor to me that in spite of what is really the tightest money in a long time, and one of the tightest money tightening campaigns, or one of the most aggressive, I should say, money tightening campaigns since Paul Volcker was around, gold is kind of hanging around the rim, at 1915, sometimes 1900, but I think it was 1950 last time I looked, which is within spitting distance of the all-time high, which is either 2050 or 70. I think it depends on if you're closing or interday, but it's only down 4%, and this is when interest rates have gone from almost zero to 5 and change. So that tells me something. I mean, that the market for gold is saying, we know what's coming, and we're not backing off. And the related, and I know probably most of your listeners aren't as involved with this, but I'm also involved with Bitcoin, and I consider it to be another sound money asset that is a good canary about monetary conditions. And Bitcoin at the low was at 15,000, and now it's up near 2930, and so it's up 80-odd% this year. I mean, how is that happening in the context of much higher interest rates? I mean, you get 5% on a 1-year treasury. Why would you need these sound money assets? And so beneath the surface, I think we see that, the market for sound money assets, gold, silver, and Bitcoin, is kind of hanging in there, if not actually going up a bit. And Bitcoin, part of the Bitcoin bump was due to the FTX collapse, which put it down to 15,000. But anyway, long story short, these things are, even gold is up 8% year to date in 2023. But it's the gold stocks that obviously have done shitty, and are kind of down off the peak. I'd say 50, it depends on whether you're in the majors, the minors, and some of the juniors are down 70%. A lot of things are down 40, 50% from the peak in 2021. And the reason for that, I think, is that basically, Toronto and the world in general, and this was in my Q2 letter, which is just put out, you can get it on my website. The world in general is actually predicting gold stocks to be flat to down over the next 5 years, gold metal prices to be flat to down over the next 5 years. And if you believe that, and then you also notice that the cost of mining is going up, and that's another change that really did occur in the last year or so, the last couple of years. I mean, there was a time in, 15, 16, 17, 18, 19, ASICs and the average cost of pulling outside of the ground was not increasing very rapidly because we didn't have a lot of inflation. But of course, inflation came along and broke out in 2020, and ASICs have been going up 15% a year. And so if you look at a gold stock, I mean, what it really is it's the price of the metal you sell is against the cost of pulling it out of the ground. and the world and the market are saying they think the price of the metal is going to be flat to down. And we all know the cost of pulling out of the ground is going up 15% a year. And so even though today, at a $1,900 gold price with an average industry ASIC of $1,200, that's a $700 margin, which is pretty damn respectable by, any measure. I think people are afraid that that'll get compressed because the 1,200 will become 13 and 14 and 15, and then the 17 won't go up. And so people believe that margins will get compressed, and therefore they don't want to pay big multiples for gold stocks. And, in my opinion, gold stocks have never been cheaper. They're silly cheap, particularly when you consider what's likely to happen to the metal. And that's kind of a macro thing that I'm not sure that's what your audience is interested in. But my brief view on macro is that they cannot continue to tighten the money supply without creating a depression-like event, a 1929, 1930, 1931 depression-like event. And so that the Fed will have to pivot, and they will pivot, and or continue to bring in other programs that are effectively pivots. Like the things started breaking with the Silicon Valley Bank breaking, and they bought in the BTFP, the Bank Term Funding Program, and there'll be more of those. And that's really just money printing. The Fed balance sheet went up massively. They gave back 2/3 of what they'd tightened when that happened. Now they're back down to where they were before that. But the point is, the Fed's got a real problem because they've got all these short maturity notes rolling over, and they're rolling over at 5%, not 50 basis points. And so, one of the best charts out there, macro charts out there, in my opinion, is the chart of U.S. federal government interest expense, and it really is just kind of a hockey stick curve going straight north, and we're now running at $900 billion a year, and the deficits are growing again. And the U.S. macro picture, we're starting to look like a third world country, wherein we our deficits grow, we sell debt to cover those deficits. There are less buyers of the debt, so the interest rate goes up. Interest rate goes up, makes the interest cost go up. Interest cost going up makes the deficit grow. And you can see where we're going here. This is either you call it a doom loop or a vicious circle. And, historically, this hasn't happened in a reserve currency in a long, long time, if ever, really. But historically, or when countries have this kind of a pattern of spending more than they're bringing in and, monetizing it, ultimately monetizing it. Right now, we're not monetizing it, but we'll have to. The currency gets devalued in real terms, and the things it'll devalue against are hard assets that can't be printed. The most notable one's gold, second one's silver, third one's real estate, fourth one's Bitcoin. So, Bitcoin's a hard asset in the sense it's a hard ledger. It's obviously not something you can touch and feel the way the other items are, but it's an immutable ledger with digital scarcity that cannot be expanded. And so therefore, some part of the world is beginning to think it's an alternative hard asset. So, it's tough. The gold stock climate is as bad as I've seen it. But I ain't selling, I ain't selling. And in fact, I'm moving around and maybe selling some of the things that haven't been hit quite as bad to buy some of the real bargains that I see. The bargains out here are just stunning. And of course, it doesn't feel good to buy in these kinds of conditions. But boy, history says that if you do buy in these kind of conditions, you can be very well rewarded for it. In my quarterly report, there's a chart that shows, what these conditions are very similar to 2000, 2001, 2002, which, led to a multi-year bull market, or to 2015, 2016, which also led to a multi-year bear market or bull market, which we're still kind of in, but we're having an interim correction here. I think that those of us who believe in sound money and believe that the government is trapped and will have to print money mathematically, we believe that. It's the nice thing about our position is that time is on our side. In other words, I think the other side is playing a losing hand, and I think there's it won't be long, in my opinion, and I think less than a year and a half, and probably less than 6 months, when gold breaks out and goes through 2050 or 2070, and it'll squirt up to 2,500 or 3,000, and then it'll be game on. And everyone who was thinking, the price of gold is going down, this will be a new all-time high. A lot of algorithms will get triggered. A lot of people will say, oh, I get it. What's going on right now, Bill, I think, is that a lot of people still believe, you have to recall that we got here by having 40 years of deflation from 1980 to 2020. And so we're 3 years past 2020. We had a big inflationary spike. And the narrative from the Fed and, Wall Street and the powers that be is, well, we'll get inflation under control. We're going to go back to that deflationary climate that we had before. And I just don't believe that. I don't think that we will. It's not that simple. I mean, someday we will possibly go back to that climate, but we've got a lot of correcting to do before we get back to that climate because of the math associated with the government situation. The way we could lose, and I've said this in other interviews, the way we could lose would be if the government suddenly, and people laugh when I say this because the odds are quite low, obviously, but if the government suddenly got incredibly responsible, chopped the military budget, stopped sending money to the Ukraine, means-tested Social Security, means-tested Medicare, raised taxes, and balanced the budget, well, that would be bad for us, for those of us who are betting on sound money. That would be bad. Those kinds of steps would clearly throw a gear in the works, and, gold wouldn't go to the 5,000 that I think it's clearly going to. But I don't see evidence of that happening. I mean, this debt ceiling debate was really amusing to me. They didn't even set a new debt ceiling. They just said it's unlimited until early 2025. And then two, the Republicans, the tough guy Republicans, said, yeah, we demand a cap for 3 years or 2 years on 7% of the spending. Well, good God, guys, what about the other 93%? So I'll leave it there. I mean, it's a dreadful climate for these stocks. On the other hand, if you have capital to commit to them, I think it's nothing but better days ahead. I've seen a bunch of these cycles. It feels as bad as it's ever felt. And I also know that typically when I feel this bad, it means we're pretty close to the end of the drawdown. So,
Larry, I've struggled so much with the cycles of even the 7.5 years that I've been in this sector, to where you have the macro picture, which you do, and you get in early, but then you kick yourself saying, am I wrong because I was so early in a non-cash flowing asset that nobody wants to buy right now? We may have talked about this before, but anything else you could share? Because I know a lot of people are at that place.
Look, I mean, it obviously, I mean, let's talk about miners and let's talk about miner buckets, okay? And let's talk about where the most volatile. I mean, the real volatile tip of the spear are the drill stories. I mean, there are two kinds. I mean, I think this is an important distinction to make. When you're looking at the mining stocks, gold mining stocks, you have gold mining stocks that have positive cash flow, and you have gold mining stocks that don't have positive. That's kind of item one people should consider when they're looking at these companies. Is this company generating profits and cash flow? Because if it's not, when will they, and or how much money do they have to raise to dilute you to get to that point? And so, the nice thing about the positive cash flow miners is that while they may not be growing a lot, while their profits may not be expanding because, the gold price isn't over 2,100 yet, they're not at risk in most cases, depending upon how levered they are, but most of them have gotten their leverage pretty under control. They're not at risk of dying or going out of business. I mean, unless gold price stays flat and they have huge cost inflation for 5 years, then they'll be at risk. I mean, as the cost of mining goes up, but $700 margin, that's good. You're good at 700. But you start there, and you don't really need, in my opinion, we've got big producers that are potential 5-baggers, 10-baggers. I mean, I did the numbers on First Majestic the other day. If I make some, assumptions about where silver is going and what they're going to do with their production, I mean, that's an easy 5-bagger, and so that's a big positive cash flow company. So you don't need to, in my opinion, be down, playing around with the drill story, speculative stuff. Now, look, some of those could be 20-baggers, but some of them are going to go to zero, if this thing doesn't turn soon. So, you kind of got a risk reward spectrum, and you got to figure out where you want to be on that risk reward spectrum as regards what stocks you want to own. But the good news is, as I say, you can buy some of these producers, that are net cash flow positive, that, will still be very, very good rates of return, and I've got a lot of producers that I like, and some of them have growth too. I mean, one that I love, a big position for me is Argonaut, right? I mean, it's, they just got the new mine going, they've got cash flow out of their legacy assets. Some of them had trouble down in Mexico. I think they'll get those fixed. I mean, it's, there are companies, there are producers that have growth that I really like. I mean, Aris Mining is another one. Silvercorp is another one. It's in China, and some people don't like that. It's stunning how cheap that stock is. I mean, it's just stunning. It assumes the Communist Party is going to take it over tomorrow, which I don't think they will. Silvercrest is another producer that I really like. Endeavor Silver, I love. And these are all producers with cash flow today. Endeavor Mining, K92 is a beautiful story. It's not cheap, but it's a beautiful story. Victoria Gold is.
And you're all over the world with jurisdictions naming those names. We should.
Absolutely. Yeah, no, in fact, ironically, I actually think Africa is not such a bad place. A lot of people shit on Africa. I tend to be a little more negative on some of the South American jurisdictions. I mean, I kind of, Peru and Argentina have kind of given me the willies a little bit. Even Mexico.
Oh, you're in Colombia, right?
Yeah. I think Colombia is okay. I like Colombia. I don't like Ecuador, and I'm not big on Bolivia either. But and Mexico's kind of given me a little bit of agita. I mean, I'm a little concerned about some of those things I see taking place in Mexico. I mean, and I think, by the way, when we have the next bull market in this stuff, I think the safe jurisdiction stocks are going to really command a premium on a multiples basis. I mean, and as Rick Rule says, there is no safe jurisdiction because, they can tax the shit out of Australia and Canada and the U.S. as well. But, those are the three obvious safe jurisdiction places where at least there is some sense of a rule of law.
What question came in? Someone wanted me to ask you about Lion One and the tradable shares. What's your perspective on this and tradable shares in general? Sorry, warrants, tradable warrants.
Look, I love tradable warrants. Personally, I'm a big bull on Lion One. We own a big position of it. I like the story. I think it's a world-class asset. They're close to having real production. The beautiful thing about any company, once it gets real production going, is that your external financing needs really decrease, and so you're not going to be diluted. And to me, Lion One is pattern recognition. It's a ring of fire deposit. It's extremely high grade. They're trying to sort it out and figure it out. And all of those things are hard to figure out. But once you do, they can be beautiful mines. I mean, I remember, Lion One is in the early days, and it's very similar to where K92 was in the early days. A lot of people were very suspicious of K92 in the early days, and it's turned into a beautiful mine. And I tend to believe that Lion One will do the same thing. So I'm very bullish on it. I mean, you've got what I think is a very big deposit. It's extremely high grade. I think you've got decent managers now, management team there. And, the valuation is quite modest for what it is. And you're on the cusp of positive cash flow. So to me, it ticks a lot of very good boxes. And I think that jurisdiction is quite safe too.
So some developers, Aridine with Mongolia Mining, they formed a JV, Osisko Mining and Goldfields also on the Windfall project. What's your thoughts on advancing?
Yeah, so let's go into those. To be honest with you, in both of those cases, I was bullish on both of those stocks, and I still kind of am. But a little bit of the bloom came off the rose, particularly in Osisko. I used to just think it was a no-brainer because I thought they were going to be able to debt finance it. And I think what he did was he decided, no, I want to just play it safe and make sure I get it financed. So I'm going to do a JV. And to me, what that did is that brought down the multiple that we're likely to earn on it as a result of the dilution of the JV.
So is it lazy or wise?
Well, yeah, unclear. I mean, if the bear market goes on for another 2 years, it'll be wise. If we turn around right now, and he could have financed it with debt based on this turnaround, then it's lazy. Then he took the easy way out and diluted the return that we're going to get. So I had a pretty sizable position in Osisko, and I took it down a lot. I had an average position in Erdene, and I didn't like what they did. I didn't like the partnering with the local. I mean, it's probably the smart thing for them to do. But to me, again, when I ran the numbers, the returns to the shareholders didn't, I'm like, nope, that's not why I'm buying these things. I'm buying them to have more upside leverage. And so I actually sold Erdene when that event occurred. I want companies and managers that think like owners and shareholders and are, that aren't just doing what's expedient to raise more money or sell off pieces of things to make sure they're successful. I want things that are going to provide real operating leverage, when the price of the metals goes higher. And, and that's why I'm willing to swing for the fences. I think companies should use debt to build some of these projects. And I know that adds risk. But, my view is if something's not at least a 2 or a 3 bagger, on conservative assumptions, I'm not interested. And because my experience has been that when things do work, they tend to become, 5, 10 baggers, 15 baggers. And that, if you think about that, that makes up for a lot of mistakes. And as we all know, we all make mistakes. I mean, we all buy companies. They don't do what they said they were going to do. It doesn't work out the way they thought it would work out, and it becomes a zero. And their troubles, their problems. I mean, and like I told you, recall, I'm living through one right now. Rise is having an extremely hard time getting a permit. And a lot of people think it's completely dead. I don't. It's not. This story's not over yet. There's a legal angle here, and there's some other levers that we can pull on here. But we could be dead. I mean, we could.
But you knew that was a binary play when you got involved.
We knew it was a binary permit play, and we've got a very large group of enviros in an area who attacked the mine, even though it doesn't cause any environmental damage whatsoever. They've attacked it. The thing they're going to have to deal with is the law. The law actually says that if it was a prior use mine, that you can continue to do it. And the law also says that unless you're disturbing, presenting clear and present danger to people or environment, you've got a right to mine. And so, the county might have, the environmentalists might have bended the county's ear to the point where the county says, hey, we don't want your mine, and our response will be fine. We'll see you in federal court, and you're taking our property, and our property is worth $1 billion. So, okay, county, what do you want to do? You want to give us the permit, or you want to write us a check for $1 billion? Now, I'm not saying we're going to win that case, but I think we could. I think our legal position is actually quite strong, and we've got $20 million invested. At a minimum, I'm pretty sure we get our money back. But the point is that these are the risks we take, right? I mean, if this mine were operating, the market cap is $5 million today. If this mine were operating, it would be worth $1 billion, because when it was last operating, it was producing 120,000 ounces of high grade, with a head grade in the in the low 20s per ounce. So, and we're quite sure there's all that gold still there. So it's a very speculative situation. It could probably go to zero. I mean, there's no doubt that if we're not able to press forward on these fronts we're working on, it will go to zero. But if it doesn't go to zero, it's not going to be 2 extra money. It's going to be 20 or 30 extra money.
Larry, so many mine builds have failed in the gold sector in the last 2.5 years. Do you think that even after the gold price turns and the gold sector gets some love again, is it going to take a few successful builds before investors begin to expect success?
Yeah, I think it is. It's going to take a few successful builds. It's going to take a few, successful drill stories that really, trade incredibly well. I mean, more than just Newfound and, the most recent flavor, Snowline, which I'm not a fan. I mean, I think it's way ahead of itself in terms of what they've done and what they've proven. And I've gotten into people with it on that subject on Twitter, but yeah, it's going to take some things working. But higher prices make things work. They make things work extremely well. And you said builds have failed. I mean, yes, they've failed in the sense that they've taken longer and cost more, which is kind of par for the course. And that's what, when we're all modeling these stocks and which ones to buy, we never take the face assumptions as being what will really happen. I mean, we take.
But I mean, Pure Gold just failed, right? It's like
well, that was
in the water.
Yeah, no, that I never believed in that one. So that one completely failed. And there've been others that have. But again, the one thing that's a positive about mining stocks, I mentioned this in my letter too. You think of your average company. Your average company has to do something, generate profits, and the profit or revenues have to be bigger than expenses to make a profit. The thing about a mining company is, and that's true. That's partly true of a mining company. The other thing about a mining company is it's actually an asset sitting there. In other words, and that doesn't go away. So let's just hypothetically, let's say you have a company that has a proven and probable reserve, really, really well drilled out, and it's 1 million ounces. Well, at today's metals prices, that's $1.9 billion of gold in the ground. Okay, $1.9 billion. If often a deposit's $1 million, you think, well, if we drilled it a bit more, it could be 2 or 3. So when you're looking at a mining, and by the way, Bill, as you know, I can go out there and show you a handful of companies that have that much gold, and the market cap is between $10 and $40 million. Okay, now, obviously the issue is, how do you get a permit? How long does it take? What's the capex? What are the risks, et cetera, et cetera. But the point is that, you've got things that are selling for, $5 an ounce in the ground, or $10 an ounce in the ground, or $15 an ounce in the ground. And that ounce is worth $1,900 when it comes out of the ground. And there's a bottom point at which, that deposit's not going away. It doesn't disappear, and so even things that where one management team messes it up, maybe another management team comes in, sees it, reconstructs it, thinks about a different way of looking at it, has the credibility to raise the capital and sorts it out. And so there's there's kind of a scavenger hunt that can be done on some of these known deposits. And this is why these drill stories always, I find them humorous. People are paying huge numbers for potential ounces when you could actually go out there and look at some of these broken drill stories, and you're paying a fraction of the ounces that they knowingly have. A good example of that is Cabral, which I'm a big holder in and I believe very much in. They got a lot of gold there. Yeah, right now it's 25 million Canadian. So what is that, 18 US? And there's millions of ounces there, millions. And some of it's actually pretty accessible at the surface and can be turned into cash flow quite quickly. So, there are situations that represent deep value. And as I say, the gold Cabral is found. It's not going away. It's there. The trick is liberating it, getting a business plan to liberate it. And that's the whole thing that, that's the venture capital piece of the mining industry. Can you bring new things on stream efficiently, on time, and do they provide enough, margin to, such that you make my view is to do a development story, you need to be penciling in on your conservative assumptions. Once you discount what management told you, you need to be looking at making it 5x your money, because you just need to be. And I've kind of done that based on, one or two of them won't work. So that's a -1, so, you do 5 at $1 and so you lose $2 and you got the other 3 and then one of them will be a 2x and then the other 2 will be 5x's. And so, you put 5 million to work and what do you get, 12? It's, and over some period of time, your IRRs, you'll be up in the 30s, 40s. That's a good set of investments. That'll work, Well,
Larry, I think we've covered it. Just for this update, I know investors wanted to hear from you. I think wanted to be encouraged and just maybe have somebody associated.
I would just say to everybody who's in this area, you're feeling pain. I'm feeling pain too. I've been here before. It's like, the older you get, the more of these things you see, the more you kind of realize, been there, done that. I talk to old hands in the business in Canada all the time. They say they've never seen it so bad, but they also, they also say, and by the way, that's why when it turns, it's going to be fierce. And we're going to make a ton of money here. And I think they're right. And we're all just waiting for that turn. And, it's coming. This BRICS currency thing might add up to something. I don't know. I have no idea. But it might add up to something. there's, gold's hanging in there. And it's not going to take much. When we get the next leg going, these things are it's going to look completely different. And so you'd much rather be buying now than buying halfway up the next leg. Because remember 2015, 16, early 2016, things went up 100% in 6 months. That could happen here. I actually sincerely believe that probably will happen.
Larry, I had like 3 10-baggers. That's what got me hooked on this sector. That was my first stocks when I didn't know what I was doing.
Exactly. Yeah, exactly. Exactly. That's the point. So, it's a difficult sector because it's so feast or famine. Yeah. It's a very difficult sector as a result of that. And, as Rick Rule says, if you're not used to being down 50%, then you shouldn't be playing, because that's, you got to be down 50%, understand what you got, know that you're right, and double down, because when it turns, it's going to go up 300%. And that's the nature of this kind of a financial bet. So, but I would say to everybody, hang in there. The math is inexorable. They can't not print, and when they do print, gold will go higher. And it's pretty straightforward. And they're gonna, just like, it's funny. Everyone believes the Fed. People still believe the Fed. And inflation's transitory. No, it's not. And they will. By the way, they will turn on a dime. They'll be able. They'll look at they got a 3% print on the headline inflation number last month, and they'll say, hey, 3. It's getting close to 2. We can define the targets up, and bang, we need to change our policy, and they will, and this stuff will go berserk. And that's kind of how I see it playing. Now, whether that's next month or in 6 months, I'm not sure. But, I'm not selling. And I think anybody who's in this area, I wouldn't advise you sell either. I mean, I think, if you want to lighten up on this area, there'll be a time to do that. It'll probably be a year and a half from now when everything's up a lot. And then try to remember, not to be too big a pig and to actually take some profits. So
good advice. Well, Larry, thank you for this update today.
Okay, hey, thanks, Bill. Enjoyed talking to you. Take care. We'll see you.